So all of these contracts, of which I don't know what portion, but I'm told it's a very significant portion of the 60 billion pounds a year here, the 250 billion euros across Europe, the $1 trillion in the US, use this benchmark, which is the mathematically incorrect benchmark for a dollar cost or pound cost average price.
I have Mike Seigne in with me this morning, former Managing Director at Goldman Sachs and Head of Execution Sales, but now, well, first of all, welcome.
Thank you very much. Pleasure to be here. My first day on TV ever, so please be kind to me.
We can't promise that.
Yeah.
But yeah, we talk a lot about buybacks on this show. This is the #1 expert on buybacks in this country, if not more.
I think you're being very generous. I would definitely not say that, but yeah, I'm trying.
And you've branched out into your own business, haven't you?
Yep.
Which is, we call it an advisory.
Technically, I'm a consultant. In order to be an advisory, I need to be licensed, and I haven't set my business up as a licensed regulatory body just right now, not for any particular reason, but I don't need it currently. So I consult.
A consultant, and really diving deep into why, well, one of the things that you're looking at the moment is why this country trades at such a discount, the stock market, the companies, and what can be done about that. In fact, we can put your latest piece of work here. This is a publication about time to tilt the scales, a call to help UK capital markets.
Yep.
Now, give us a bit of background and then what this takes us.
Sure. So by background, I'm an equity execution guy. So what that means is historically, I've helped investors when they make a decision to buy or sell a security. Don't ask me what you should buy or sell. I'm hopeless at that. But once they've made that decision, how to efficiently transact it. And by efficient, what we're really looking at is how to not spend as much money as you otherwise would. So if you've got £100 and you want to try and buy, whatever it is, Vodafone, I want you to try and help you buy as many shares as possible for that £100, including all of the transaction costs and all those sort of things, and just try and do that efficiently.
Yeah.
So since, I sort of have spent 30 years helping customers do that in various different ways across lots of different types of customers, lots of different ways of transacting, from portfolio trading, algorithmic trading, etc. My last role, I was running the execution service of a relatively small business, and we sold that business to a very large investment bank.
And was that Redburn?
It was involved in helping to manage Redburn, and I was responsible for their execution services.
Right.
And we sold that business to a company called Rothschild & Co.
Right.
And in that transaction, one of the things that the Rothschild & Co. bankers wanted me and my execution team to help them with was to build pitch books to sell the execution services of the new broker that they had bought. What was going to become their equity department, if you like, to try and help corporates do transactions. And it was, they were interested in pitch books to try and help with share buybacks.
Yeah.
And that was when I sort of first had a real proper look at and trying to understand how does the market execute buybacks and how are things set up. I'd done a little bit before, but really I wasn't really involved.
Because it is very complex, isn't it? But I remember, 2011 it must have been, I was doing Rio Tinto's buyback.
Yep.
So about $2 billion over the 12 months.
Yep.
But we were buying up to 100,000 shares a day with a target of the VWAP. And anybody who doesn't know VWAP, it's a very technical term used in banking that is just the volume weighted average price. So my target was to beat this average price during the day, but you could cheat, because if the stock went down, then the company would just send another 50,000 shares to buy. So you always looked good against this VWAP.
Yeah.
And there is a lot of ways that banks are helping themselves look very good in these transactions, isn't it? And the cost that you detail in this article is astronomical.
So, if we go back to what am I trying to do, and then I'll bring it back into that process. So I'm trying to help corporates, when they transact in their own shares, do that efficiently. So if you want to buy £1 billion of your own shares, which is the average FTSE 100 company buys £1 billion worth of their own shares a year, it's just a little more. So last year, I think it was 54 FTSE 100 companies executed a buyback of larger than 1% of number of shares outstanding, so a significant buyback. And the cumulative value spent was about £57 billion. So, each one, that's an average, as opposed to like Shell alone is buying back, I think it's $15 billion a year, $3.5 billion a quarter. So that multiply that by 4, is that 15? Something like that. Anyway.
Yeah.
So when you look at those sorts of transactions and measure them through the eyes of how would an investor think about transacting a buy order of that size, and you measure things from that perspective, I estimate, and it is an estimate, it's definitely not based on hard data, but people can challenge me on this and have challenged me on it, and we walk away going, okay, that's fair enough.
And it comes from a lot of experience.
And there's a bit of experience behind it, yeah. And I estimated at about 7% on average for these very large transactions for a buyback executed in the UK.
Yeah, so that's the cost to
That's
the
the total cost for everything, which is borne by the shareholders, because the shareholders own the company, right? And by comparison, somebody else, Man Group, estimated a similar process for the S&P 500 in the US and came up with a number of about 3%. So if my guesstimate is close to right, which I think it is, then there's a 4% difference for every dollar that you buy back in the UK versus the US. Yeah. So now that doesn't cause a valuation discount, right? We have a lot of problems in the UK right now where, if we look back the last 18 months to December 2024, so last December, we lost a net 115 companies listed in the UK in the what we call a primary listing. As a percentage, and we ended the year, I think it was with 972. So that's more than 10% of listings lost in 18 months to December.
And that's
this year.
Takeovers.
Correct. Delistings, moving listings, takeovers, take privates, M&A, all of that stuff combined. And it's devastating from the UK's perspective because our financial service industry, whether you're in private equity or whether you're in public equity, whether you're in debt or anything, we need to have healthy public markets to be able to function. And the first thing you need for a healthy public market is investors willing to risk their capital. They expect a healthy return in order to be able to risk their capital. Right? If they get a better return for the same risk somewhere else, they will do that. And the second thing you need is companies who are looking for that capital to come and regenerate your public market so that we have more companies coming to market than leaving our market. Otherwise, we shrink to zero. And that has has an awful negative value to our country, right? So it's really important, much that people will like to dislike people in financial services, it is a pretty critical business in our economy in general.
That's what my mother always said. She said, you don't listen to these people that say about you being a bad banker. Look at all the tax that the industry pays to the government. It's an astronomical amount. So this is an important part of the economy. We've got a question right there. Why do companies pursue buyback programs in the first place? And your publication does actually go through the reasons for that.
So I'm an execution guy. I'm not a capital allocation guy within a company. So don't take it from me, but this is kind of what I've learned, and I'm very early on my learning curve from a corporate finance perspective. But if a company has excess capital, so it can afford to return some of that capital to shareholders, then it has two choices. It can return it via dividends, or it can return it via share buybacks. And there are reasons why share buybacks may be more favorable or dividends may be more favorable. But generically speaking, if your company is trading, the share price of your company is trading at a discount to what people think is the fair valuation, then share buybacks they transfer wealth to the remaining shareholders from the shareholders who choose to sell.
And they do that because you're reducing the share count.
The share count. So if you've got a company which has got 100 shares outstanding and it wants to return £100 to those shareholders. If it did it via a dividend, each shareholder would receive £1. Right? It's pretty simple. So imagine you owned 10 of these shares, so you are a 10% holder.
Yeah.
If it wants to return the same £100 but do it via a buyback, it has to go and buy those shares from the share register, from the shareholders, and it can do that in a number of ways. If it does it through the market, what we would call an open market transaction, you can't actually buy the share from the selling shareholder because the selling shareholders will sell it to the market, and you as a company have to buy it from the market, which is where these rules you were coming into talking about before, right? There are rules as to how you're, as a company, you're allowed to buy the shares so that you don't get accused of manipulating your own share price.
Yeah, absolutely.
Those sorts of things. So, when that enters the equation, the company has to go and buy shares from the market. Now, that's a technically challenging thing to do. It's easy for £100.
Yeah.
It's very different for £1 billion because the share price, it can take a long time. The share price can move around. But these companies typically don't have internal trading expertise.
Right.
So you can imagine if you're an investor, so you're Warren Buffett's, Berkshire Hathaway, or you're Fidelity or whoever.
Yeah.
If you want to buy £1 billion of something, you give that to your internal trader, and their job is to protect your interests and to try and turn that into as many shares as possible in a risk and cost-efficient manner, right? I mean, that's a very specialized world. Absolutely. And this is where you and I used to live, right? With one way or another, we were involved in this process. And there are lots and lots of tricks. The buy-side trader, as we would call it, this person, the investor who's looking after this transaction, their job is to understand how to do this as efficiently as they possibly can. And the intermediaries, so the brokers in general, hopefully not the broker who the buy-side trader is transacting with through that on that day, but the market's job is to try and extract as much value from those orders as the market makers, all these people. They provide a fantastic service, but like their job is to try and make money from other people trading.
Yes.
That's what their job is, essentially. And so there's a game going on, and it's complicated, and it has lots and lots of different layers and cleverness and complexity and stuff like that. And professional traders, their job is to understand how to not get taken advantage of or abused or whatever you want to call it. A corporate, when you actually go and talk to the corporates, this is, they don't know what they don't know. They don't know the tricks of the market.
A huge information disadvantage.
Yeah, massive disadvantage. And when you talk to these people, they're IR or they're treasury or they work within the finance department. They're fantastically competent people, but they just don't know the tricks. And so they're vulnerable to being taken advantage of, and it happens a lot. And when you think about the scale, and we're just talking in the UK, 60 billion or 57 billion pounds last year. If you can make an extra 10 basis points or 50 basis points or 1% from that, and I'm saying it's about 4% in total, that's a lot for the market.
And that's just the 4% compared with the US, and it might be going on there as well.
Oh, there's games going on in the US too, for sure. The US is not a perfect model, but I picked it because it's deemed to be a more competitive market.
Yeah.
So that's and then also I can find the data or somebody else's work.
Why is there a 4% gap, Andrew McKelvey's asking, between the UK and the USA, and is it being sorted?
Okay, there isn't a 4% gap. This is me estimating a 4% gap, so it's not factually right process. So I think the reasons why, I think the fundamental, most obvious reason why there's a big gap is what we would call information leakage. So these transactions are big. If you're a US listed company and you want to do a buyback, your board has made a decision and approved a decision to return capital via a buyback. The only disclosure you need to make is when the board makes the approval, which is a permission to the executives that you can do a buyback. And that's disclosed through AGMs and publicly disclosed as it should be, right? We can't have a company transacting in its own shares without the shareholders knowing. That would be very unfair. Yeah. But now that's a permission. They don't need to do the transaction. They have an option to or a choice to do so. And if they choose to do so, they don't have to tell the market until their 10Ks and 10Qs, so quarterly numbers after the fact. So, there's an advantage when you were trying to buy £1 billion of something that the market doesn't know you're starting to. Okay?
Absolutely.
So in the UK, the way we've set up our safe harbor rules and where companies get the legal protection from being litigated against or challenged from a legal perspective, the rules say that if you want to do a share buyback and stay within the safe harbor, when you take that permission from your board and turn it into an intention to buy, before you buy a single share, you have to disclose. So what you'll see in what we call the regulatory news, so the RNS,
We've got an example here. We'll pop Vodafone up.
Okay.
And you can see, this. Not only do you get the pre-announcement that it's going to happen, but you also get daily, down to the very share, how many shares they've bought, which means people like me and our other viewers can try and take advantage of it.
Correct.
Because we know on a half-day bank holiday going into Christmas, they're trying to buy a whole day's worth of shares.
Maybe.
And the stock goes up 3%.
They don't have to, but they can.
Well, that is what happened.
Yeah. But the point is that before a company has to buy a single share, they have to tell the market, we're going to start buying £1 billion of our own shares, or whatever the number is, today. We expect to finish, there's a series of things, minimum things they have to explain. And then every day that they do a transaction, they have to update the market on how the transaction is done. And if you look, you'll also find what we would call every single X lot. So every single child order. So, at 8:04 in the morning, right after the market is opened, the company might buy 1,000 shares from the London Stock Exchange, and at 8:05 they might buy 1,200 shares from Aquis, and you have to disclose all of this. So anybody who knows what they're looking at, so you and me, we spend our lives in this stuff, get a very, very good idea of what's going on. And that does lead to opportunities for totally legal front running, which I think is not the way that we should design the market if we want to try and protect the long-term investor. Absolutely. So the question to the regulator really is, who are you trying to protect? And you have to make some judgment balances as to who you're trying to protect. I think this particular disclosure law is excellent insofar as they're the best disclosure laws in the world, in my opinion.
For transparency.
From a transparency perspective. But the cost of having it near live has a tremendous cost on the company and therefore the remaining shareholders within the company. So I would propose that we keep the level of transparency, but we delay the information so that you get it a quarter later or something like that, so that the value of the transparency is there, but the trading value has diminished. Those sorts of things. Now, I'm just proposing it. It's not like I've based this on any fantastic study which will say this is the optimal one, but I'm just saying it will be an awful lot better. And it's the same as what we have in the US, so it's an easy thing to copy.
Yeah. And it's just like when we used to get taken out of $50 million of something, then you could keep the print back for a certain number of hours until the next day.
Yeah.
So it's that on a...
It's that, but the scale of these transactions is just dramatically bigger. The single biggest orders in our market, on the buy side certainly, are share buybacks, without a shadow of a doubt, in aggregate. So in answer to your question, the 4%, I think a lot of the differential between the UK and the US is to do with this disclosure stuff. There's other reasons. There's two other reasons, I think. One is the execution products, but to be frank, they're no better in the US, but it contributes to the total cost. In fact, you could argue that they're worse in the US. I don't know why I'm pointing over here for the US, but where I sit at home, this way is west. And then the other one is the way that we've designed the access. So if you want to try and buy a lot of things from sellers, you need to try and find where are the sellers going to be selling it. And within our market, as you probably understand, your listeners probably understand, we have lots of different mini exchanges within the market. So we've got London Stock, we've got these things called dark pools, and all these sorts of things. You want to be able to go where you can buy the shares from the sellers, and most of the sellers over time tend to be the professional money managers is where most, not all, but if you go and look, by percentage of ownership, the vast majority is owned by professional. So you want to be able to go there.
And then just going back to Maturin's question, so to underline your view and the view of obviously the companies as well, it does benefit the company if they perceive the share to be worth less than the market or worth less than the valuation would otherwise suggest. So cancelling the shares does help you have a bigger EPS.
It does, yeah. So if I can steal from Warren Buffett and just explain that why it makes sense and when it makes sense to do a buyback and when it doesn't. So if we take Warren Buffett, and apologies, Mr. Buffett, because I'm gonna steal your idea and probably get it. I'm probably
far worse here.
Probably get it wrong. So imagine we have a 3-share company. You own 1 share, I own 1 share, and Mr. Buffett owns 1 share. So it's a 3-share company. And the total value of the company is £3,000,
okay.
right? So we don't need to worry about how we value this company. You don't need a super analyst to come and forecast future earnings and do discounted cash flows or you know exactly what the value is. It's £3,000. There's no question. And the company wants to do a buyback, and I choose to sell my share. My share has a value, the moment per share value, of £1,000. Yep. But the company, says, Mike, we'll offer you £800, and say I really need the money because I need school fees or something like that, whatever it is, and I sell at £800.
Okay.
What's happened is, and the company then buys that share, cancels it, so it becomes a 2-share company, and I take £800.
Yep.
What you get left with is a 2-share company, so which has got a market cap of 2 shares times 800 is the price, right? So it's a £1,600 market cap company based off the last price, but it has a value of £2,200.
A perceived value.
Correct. Now you used to own a third of it. You now own 50% of this, right? You owned 1 share at the start, 1 share at the end, but the value of your share, not the price, has gone up from, your ownership of the company has gone up from £1,000 to £1,100, right? So the point is that if the company, it was the company that bought my share, not you, not Mr. Buffett, the company, if the company buys my share below its intrinsic value or its asset value or its NAV, whatever value process you're using, then it transfers wealth from the seller to the remaining shareholders because you own the share. Now, if we did it the other way around and I agreed to sell my share to the company at £1,200, then the residual company is worth whatever that is, 1,800, and your shares are worth 900 each. Right? So the value transfer happens the other way.
Got it.
So it's really important at a board level, and I think boards really, really understand this very well, is that if you're going to approve a buyback, you should only approve it at a price which you have reasonable confidence that it's at a discount or at least not higher than the value of the company.
And that's one of your main arguments, because so Mike has an amazing LinkedIn that he produces a lot of publications, research, and
research would be generous, opinions.
But you take real situations where you've seen what the details are and cannot believe that these companies have paid.
Yeah, no, it's less to do with, I have no idea what valuation is. I mean, in theory, I know what it is, but I'm not an analyst. I wouldn't be able to tell you if Vodafone is undervalued or overvalued. I wouldn't have a clue.
Yeah, or BAT.
BAT or anything, right? Yeah. But what I do understand is how to efficiently transact. So maybe I should explain. One of the things I'm very critical of is that there is a subset of structured products which typically investment banks sell to corporates, which are very, very clever and look fantastic, but there are a whole series of tricks. And I mean a whole series of tricks. Maybe I should explain that. Okay, so the key component within all of this process is, what is the execution benchmark, which is used to calculate if the execution was better or worse than, and often the profitability for the broker, the fees are arranged from a performance perspective, so that they make more money if the execution is better than the benchmark. And the standard benchmark is what's called the arithmetic average of the daily share price. So if you have £100 million, and let's say you agree it's going to take 100 days to transact, what that means is that you would effectively end up buying £1 worth of shares every day for 100 days. Okay. Now, the important bit is that in the contract, it's very, very clear. It says that we will guarantee an outperformance or a match of performance to the arithmetic average of the daily share price. Now, the arithmetic average, or simple average of the daily share price, is day 1 plus day 2 plus day 3 plus day all the way up to day 100 is that share price summed divided by 100
days.
And that's the arithmetic average. It's a common average that we all think. Now, the trick is that I was looking this up. You know, I put it in ChatGPT, how many different averages are there in the world? And it came up with 13, but said there's a whole bunch more. So you've got medians, you've got Bayesian mean, you've got all sorts of averages. The trick is in understanding that. So can I try and explain just the difference and where the trick is from that process?
Oh, please.
Okay, so imagine we've got a super simple, so I'm going to pick a really super simple example. You have £200 to buy in a share buyback. And because this particular share I'm going to pick has extremely high share price volatility, which means the share price might be 50 one day, 100 the next day, 30 the next, right? It's going all over the place. And I'm deliberately doing that just to be able to show you in the maths. And, you know, you agree with your boss, look, because this thing is moving around so much and I have to buy £200 worth, I'm going to buy £100 on day 1. And then let's wait a month, say, and then I'll buy £100 of shares on day 2.
Yep.
And you agree with your boss that, okay, what a good outcome would be if you beat the average.
Yeah.
Okay, so you come to me and I say, I've got a fantastic product for you. Okay, so I understand the problem. You've got £200 to spend. You want to spend £100 on 2 different days. I'll tell you what, I will guarantee you a 1% discount to the average price over those 2 days.
Okay.
Okay.
Deal.
Yep. Okay, you're happy with that, okay?
Yeah.
So just to be clear, if the share price is 98 on day 1 and 102 on day 2, the average price will be 100, and I will guarantee you that I will sell you shares at £99. So you will buy them at £99 per share, 99p, right? So that's a 1% discount. Happy?
Yeah.
Right, should we sign the contract?
Deal.
Okay. What I've agreed, and you've agreed with me, is the arithmetic average of the share price. Okay, now let's look at what happens. So on day 1, we spend £100 at £50 per share, and I'm going to end up buying 2 shares. Okay?
Yep.
First of all, let me just ask you, do you think I lost money or I made money in this transaction? Optically, it looks like I lost money, right? Because, you know, the average is 75, and you bought them at 74 and a bit.
Yeah.
0.3, whatever the number is.
Okay, so the company looks clever.
So it looks like you know, this was the average price, and you bought them at just below the average, 1% below. So do you think I've made money or lost money?
You as the...
Me as the broker.
The broker.
Guaranteed you this 1% discount to the average.
Well, it looks like you've lost money.
Optically, it looks like I've lost money. Okay, yeah, I would agree with you. And this is what I was feeling. I only figured this bit out this week.
Right.
Which I can't believe. I read about this 3 years ago, but I have a sort of a degree in maths, different stories, sort of. So I thought I understand averages, which is the arrogance of knowing stuff, right? So,
Yeah.
So on day 1, I have bought 2 shares. On day 2, I spent £100 at 100, so I buy 1 share.
Yeah.
So in total, I have spent £200 and I've bought 3 shares. What's the average purchase price? It's 66.
Yeah.
Okay, so I've 0.6, whatever. So I've bought shares at £66 and I've sold them to you at £74. So I've made 11, 12%, whatever that difference is.
Yeah, huge.
It looks like magic. Yeah. Now, it's because the arithmetic average is not the representation of what you would get if you spent the same value every day for 100 days, or for whatever the number was, or for 2 days. That average is called a harmonic average.
Right.
Which I'd never heard of until this week.
So the harmonic average is generally lower than the...
The harmonic average cannot ever mathematically be higher than the arithmetic average or the simple average.
We saw this happen because in VOD's buyback, and we track the number of shares every day, they had an average of 16 million to buy a day, and it was perhaps one of your former employers that was doing it. And they came out and they bought 30 million shares day 1. And I was, wow, they're only meant to buy 16. 30 million shares day 2.
Yeah.
Day 3, 36 million shares. And I could not understand, but that was at 66 pence. Next thing, the share was 70p.
Well, yeah, the point I'm trying to make is that would require predicting the share price. That is, there is a genuine risk in this. This one, you know, I didn't do anything clever as the broker. I just executed, £100 a day at the market price. So the difference between...
Sorry, that's why you bought 2 lots of 50.
That's why I bought 2 lots of £100.
Right, gotcha.
So the point I'm trying to make is that the cleverness in the contracts at their very base level, before you start to add all the bells and whistles, which trust me, these things get super complicated. But before you even start, like the broker, by taking zero risk, is guaranteed to not lose money. I mean, assuming that the share price is more volatile than the 1%. But if I guaranteed, no discount, but I'll guarantee you can never be, and you said yes, then what I've done is I've basically given you a simple average when I know that I'm going to get the harmonic average. And I know by definition, because of mathematically, it's impossible for the harmonic average to be higher. And I'm buying it.
The light bulb went when I realised you were promising to buy 100. You were spending £100 a day.
Pound is the value. Yeah, if I'd spent shares, it's different, right? But
so you
because
need to
it's a value, exactly. So that strategy, execution strategy, where you spend the same value every single day, is called a pound cost averaging or a dollar cost averaging. And the correct way to calculate the price at which you will buy the shares is the harmonic average.
Got it.
Not there. So all of these contracts, of which I don't know what portion, but I'm told it's a very significant portion of the £60 billion a year here, the 250 billion euros across Europe, the $1 trillion in the US, use this benchmark, which is the mathematically incorrect benchmark for a dollar cost or pound cost average price. So I don't know how you feel about this process, but when I figured this out, I felt a bit cheated. I'm like, okay, well, the guy just cheated. His or her understanding of the fact that it's like, if you ask me what's a Bayesian average, I wouldn't even know where to start. I just don't know. But because I don't normally do this stuff, they've taken advantage of my ignorance for no risk as the starting point, and then they build risk onto it and all this thing.
But made it look good.
So I think there's a problem coming in the market because of this sort of stuff. Because the amount of money we're talking about is enormous. I mean, genuinely enormous amount of money.
Now, Mike, you've got a website. We're going to have to dash, but if we can just show the website there up, and it is candorpartners.net.
Yep, candorpartners.net.
And people can add you on LinkedIn.
And if I can make a wish, if you're a company board, I genuinely think that you need help insofar as an expert sitting beside you who understands some of the way execution, because if I can't predict what will happen, but it doesn't take a rocket science to figure out that there could be some legal action coming at some point in some way. And I think it's the board members who are technically at risk for this stuff because, they are unwittingly they don't know the right questions to ask. And so my business is to try and help boards and investors in companies make sure that when a company is trying to return capital to its shareholders, as much of that capital returns to the shareholders and improves shareholder return, and less of it goes to the intermediaries whose game it is to try and extract as much of that value as possible. So that's my business, and I would love to be able to help.
Michael, thanks so much.
Thank you very much.